At a first glance, this looks like a great rental property. It's freshly updated, it's move-in ready, there's nothing to fix. Honestly, this is exactly the kind of house a rookie investor gets excited about, and exactly the kind of house that can quietly destroy your returns. Today I'm going to show you why someone is probably going to overpay for this property and why they may not realize it until it's too late. And trust me, the biggest problem with this house is not what most beginners are going to think. If you're trying to learn how to analyze rental properties and to avoid expensive mistakes, make sure you subscribe, because on this channel we break down real listings and expose what actually makes a good deal or a bad deal. So let's jump right into this one. So this is the listing right here. I completely understand why this house is attractive. The outside looks nice and the inside looks great. I walked this property, everything is ready to go, and the updates are actually nice. This isn't a lipstick on a pig kind of situation. The updates are actually good updates. The kitchen is nice, the floor is nice, you got recessed LEDs and the ceiling. It looks easy and it feels safe. And that's exactly why rookie investors love these types of properties. Perfect, I can buy this property and start collecting rent immediately. There's a couple of major issues with this property though, and both of them will kill your returns before you even close. The first problem is that this house is rent capped from day one. So let's go back to the main listing right here. Two big problems. It's a 2-bed, 1-bath. Immediately that's going to cap the rent because it's a small home. Now, that's not necessarily the end of the world. I've got a 2-bed, 1-bath that rents very well, but the other side of the equation is low square footage. 672 square feet is going to cap the rent even more. And that is that's going to equate to hundreds of dollars potentially lost in monthly rental revenues. I can overlook that depending upon the price, but the problem is this house is nicely updated. They did a good job flipping the house. They're not going to sell this one cheap. So you've got, and the third problem, forced equity has already taken place. And what I mean by that is the property that I bought that was 2-bed, 1-bath, number one, had a higher square foot count. It was 990 square feet, but also the inside was very messy and needed a lot of work. So I got it cheap because it was a smaller house and needed a lot of work. I updated it, forced equity, raised the value immediately from the work that I did, and also that's going to raise the rent. You may think, well, but the inside of it's very nice. I'm going to be able to rent it for a nice dollar amount per month. The answer is kind of. Okay, again, the bigger caps are going to be bed count and square footage, and you're already working at a big disadvantage there. So let's jump into the numbers real quick so we can talk dollars and cents. Okay, modest estimates for rent are going to be, and I always recommend, if you're going to be financing this or looking to buy, always estimate on the low end. If you estimate on the high end, like $925, and you find out I'm not going to rent this for $925, I'm renting it at $850, it's a bad deal. If you estimate on the low side and you find out, oh, I can get a tenant in here for $75 extra a month, that's icing on the cake. If we go with the modest numbers, $850 a month, which is, I think, probably within the realm of very possible for a 2-bed, 1-bath, less than 700 square feet house, that's probably what you're looking at, even though it is very nice on the inside. You're looking at a raw cash-on-cash return of about 12.43%, which, depending upon where you live and depending upon the market in your backyard, you may be thinking, well, that's not that bad. But to be honest, in the Akron area, Akron, Ohio, you can do a lot better. On the aggressive end, bumping it up to $925 a month, you're still only looking at a modest increase, 13.5%. The first property that I bought, to put into perspective, that I bought in 2024, I'm getting about almost 17%. Okay, the estimated mortgage payment for this property is going to be $562 a month, and these are just some rough calculations, assuming that you're managing it yourself. The numbers are worse if you factor in a 10% property management fee, but $850 minus the mortgage leaves you with $288 a month left over. So it is cash flow positive. That's great, but there's not a lot of margin here. If you are able to rent it for more, obviously the margin is going to increase, but this is a more optimistic figure. $850, I would say, is more grounded in reality. Alternatively, you spend a little bit more, or you find something similarly priced that is a little distressed on the inside, and you get it at a lower price, or closer to The property, I don't think I have this on here, but the property, I walked it several months ago. The property did end up selling. It sold for $82,000, even $82,000 flat. Okay, $82,000 in the West Akron market. If you're patient, you should be able to find something in that general price point for about a 3-bed, 1-bath, 1,100 square feet. And that goes into the alternatively right here. If you're able to spend equivalent on a distressed property or a little bit more to get a 3 to 4 bedroom, 1-bath house, you're looking at a marginally increased mortgage payment and a significantly increased monthly rent. And now, if you're having to finance it, the cash flow positivity is looking a lot better. The raw cash-on-cash return is looking a whole lot better too. And so that's the real big thing with these deal analysis. You have to look at, when I looked at this property, immediately I looked at it, I'm like, this is nice, but it is too nice. I'm not going to be able to capture any of that forced equity. It's already happened. And because of that, I'm going to have to pay more. That's going to cause my raw cash-on-cash to drop down. And the returns obviously aren't going to be as good. My margins are going to be worse if I'm having to finance. If I'm paying cash for it, that's fine. And you may think, well, if I pay cash for it, what's the big deal? And if you do that, that's fine. Okay, if you've got the cash to pay and you don't want to do any type of rehab work, this may be a not a bad option for you. On my end, I like to see the cash-on-cash returns a lot higher. Well, I shouldn't say a lot, but I like to see them higher than that. And I don't really love the fact that rent is going to be capped relatively low. Again, $850, I feel like is relatively low for the area. Personally, I would be more on board with that if the price was lower. If it was a $60,000 home or a $55,000 or $50,000 home and the rent was only going to be, best case scenario, $850, I could live with that because I'm paying less for the house. But again, the problems I see with this, forced equity has already happened. Number two, you're capped with the bedroom and bath count, and you're capped with the square feet. 3 negatives right off the bat. Not a real good situation if you ask me. For some investors, this may be perfect if you want to be really hands-off, you don't want to get your hands dirty. That may be the way that you want to go. So before you buy a turnkey rental, you need to ask yourself, am I buying an investment or am I buying somebody else's flip? I looked at it, I was buying somebody else's flip. I didn't want to do that. If this breakdown has helped you and you think differently about rental properties now, please hit the like button. It really helps this channel grow. And please subscribe if you want to see more real-world deal analysis like this. If you have a listing that you want me to break down, drop the address or link in a comment, and I might just feature it in the next video. See you in the next one.